This video is an Uncovered Japan company research report on DIP Corporation, ticker 2379. DIP runs Baitoru, one of Japan's leading platforms for part-time work, alongside a smaller HR software business. It is debt-free and high-yielding, but it is also working through its first revenue decline in years. This is a research overview. At the report date, DIP traded at 16.1 times trailing earnings and yielded 5.29%. Return on equity was 16.4%, and the equity ratio was 73.7%. Those figures describe a financially resilient company. The issue for investors is not leverage, it is whether earnings can stabilize while the recruiting market and pricing model change. The core product is Baitoru, a recruitment marketplace for part-time and shift work, used by restaurants, retailers, logistics operators, and other service employers. DIP's model is more hands-on than a pure search engine. Its roughly 2,000 salespeople help clients advertise and recruit. The company is also selling cobot software that automates recruiting and local marketing, giving it a second route into the same employer relationships. The segment split explains both the opportunity and the risk. HR services accounted for 88% of fiscal 2026 sales and earned a 31.5% segment margin. The smaller DX segment was only 12% of sales, but generated a 56.1% margin. The high-margin software arm is promising, yet it remains too small to offset a sustained decline in the much larger advertising franchise on its own. From fiscal 2022 through fiscal 2025, DIP's revenue and operating profit rose sharply. Fiscal 2026 broke that pattern. Revenue declined 2.7% to 54.9 billion yen, while operating profit fell 32% to 9.1 billion yen. The report attributes the operating leverage to a softer core business, reorganization effects, and front-loaded investment. That sudden drop is why the valuation debate now centers on recovery rather than growth. The fiscal 2026 profit decline was not just a revenue story. Operating profit fell to 9.1 billion yen, and net income to 6 billion yen. Advertising and personnel costs are meaningful and relatively sticky against a listing fee revenue model, so a modest sales decline had a much larger effect on profit. The balance sheet provides room to navigate that pressure, but it does not remove the need for the core business to regain momentum. DIP's advantage is a distribution moat. Its direct sales force, Baitoru brand, roughly 150,000 company relationships, and an estimated 22.7 million monthly Baitoru users create a valuable local recruiting network. But the report draws an important distinction. This is not an untouchable platform moat. Pay-per-click search engines, such as Indeed and Kyujinbox, are changing how employers buy job advertising, putting pressure on the traditional listing fee model. DIP has returned substantial capital through a progressive dividend and buybacks. The fiscal 2026 yield was 5.29%, while the company bought back 13.5 billion yen of stock across fiscal 2024 and 2025. The caution is coverage. The fiscal 2026 payout ratio reached 83.5%, and the report notes that dividends had begun to exceed free cash flow. The dividend is therefore an earnings question, not just a balance sheet question. Management's response is a CPC hybrid pricing model, the spot Baitoru entry into same-day shift work, expansion of high-margin DX software, and AI initiatives. Each lever has a plausible strategic logic. The credibility gap is execution. The report highlights a prior withdrawn plan and a current longer-term target that remains far above the near-term revenue trajectory. Investors should watch the individual operating milestones rather than assume the headline aspiration will be met. The valuation history is unusually clear. DIP's price-to-book multiple fell from roughly 6.6 times in fiscal 2022 to 2.6 times in the report's current period, declining every year as growth expectations receded. At 16.1 times trailing earnings, it traded below the cited services sector average, but the report does not frame it as a simple bargain. The multiple already reflects a company the market sees as a value and yield name, not a growth story. The report's 3-year scenarios are deliberately broad. The bear case reaches 621 yen if CPC cannibalization and the spot Baitoru investment disappoint. The base case is 2,370 yen on a modest recovery, while the bull case is 5,063 yen if the transition works and margins rebuild. These are author estimates, not targets, and their spread is a reminder that the investment case rests on operational evidence still to come. DIP combines a recognized recruiting brand, direct distribution, a debt-free balance sheet, and a high dividend yield. Against that, The core business has just declined. The software arm is still small, and the transition to CPC pricing and spot work will demand execution. The two questions to follow are whether revenue stabilizes as pricing changes and whether earnings can continue to support the dividend. For the full research series, visit Uncover Japan. For a much deeper look, visit the free deep dive at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.